If you sit on a condo association board or even live in a condo community, there's a new set of mortgage rules coming that will affect every unit in your building. In March of this year, March of 2026, Fannie Mae and Freddie Mac announced the biggest overhaul of condo financing standards in years. Most of the attention went to one number, the minimum reserve funding requirement. The minimum reserve funding requirement is going from 10% to 15%. And the deadline that matters most hits on January 4th of 2027. So this video is to kind of help you prepare for that. Now, one important thing to understand right up front, these rules apply to condos only, but they're not straight up laws, right? So this doesn't impact like single family HOAs, but condo specific. Now, there is no state statute or no federal law or nothing your legislature passed. They're mortgage requirements set by the two companies that buy most of the home loans in this country. And in a minute, I'll explain why that actually gives them more power over your building or your community than really even a law would, if you think about it. Here's what we're going to be covering: who makes these rules and why you can't ignore them, the two changes that matter most, why this applies nationwide no matter what state you're in, what actually happens to your building or your community if you miss the bar, and then finally the workaround almost nobody is explaining correctly and exactly what your board should do before January. Quick introduction if we haven't met before. I'm Joe Braun, the founder of Solume. We're an all-in-one management software for condo and HOA communities. If you find this helpful, do me a favor and like and subscribe to the video. It genuinely helps us get this in front of more boards who need to see it. All right, let's walk through this. First, let's address the obvious question. Who are Fannie Mae and Freddie Mac and why do their rules apply to your board? Here's a simple version. When a bank writes a mortgage, it usually doesn't keep that loan. Maybe it keeps it for a year or two, a couple of years, and then it gets rid of it. It sells it. And the two biggest buyers of home loans in America are Fannie Mae and Freddie Mac, two government-sponsored companies that purchase most of the conventional mortgages in the country, those two entities. Because they buy up so many of these loans and stand behind them, those loans are considered extremely safe and stable. And that's exactly why they keep getting stricter. When you're backing that many mortgages, you protect yourself by making sure the property behind them are financially healthy. And we're going to talk about what that means. Now, think about what this means for your building or your community. If you make your living writing loans, you write them to the standards of the people who are going to buy them every time. A lender isn't going to write a mortgage that they can't turn around and sell. It's just bad business for them. So here's the part that might be confusing. These new rules, they're not necessarily laws. So they weren't passed by Congress, right? No governor signed them. There's no statute requiring your association to comply. But it doesn't matter because if your building or your community does not meet these standards, lenders simply won't write conventional mortgages in it. Think of it sort of like a grocery store buying apples from a farmer. The store isn't breaking any laws by turning down bruised apples. They just won't buy them. And if the stores won't buy, then the farmer can't sell them. So your building in this example is the apples. If it's financially bruised, if the numbers don't meet the standard, the lenders reject it. And suddenly, nobody can sell a unit in your building to a buyer who needs a mortgage. We'll talk about exactly what makes a building bruised in just a moment. There's an industry word for a building that passes. It's warrantable. A warrantable building qualifies for conventional financing or for a conventional loan. A non-warrantable building doesn't. Hold on to that word, warrantable, because by the end of this video, you're going to know exactly how to keep your building on the right side of it. All right, so there are two changes that matter. Here's the first. For years, a lot of condo loans went through something called a limited review. Think of it sort of like TSA pre-check at the airport. If the buyer put enough money down, the lender ran a lighter check on the building or on the association. Less paperwork, fewer questions, faster approval, and a lot of buildings with, shaky finances, they sort of slid through the fast lane for years because nobody was looking too hard into it. So they just kind of slid on through. That lane is closing for loan applications dated on or after August 3rd. So right now, today, the limited review is being eliminated for established condo projects with more than 10 units. Let me translate what that means because maybe it just sounds like jargon. Established just means that it's a finished and up and running building or a community, not new construction that's still being developed or selling its first units. And more than 10 units means that it applies to every building or every community with 11 units or more. So if you're a completed condo community of 11 units or more, this is for you. Every loan in your building now goes through what's called a full review. And the full review means your lender examines your association. Think about it, not just the buyer, the association's budget, your reserve funding, your insurance, your delinquency rates, any pending lawsuits, special assessments, inspection reports. So pause this video and screenshot that. Read that list again because it's the whole point of this video. A buyer with a perfect credit score and big down payment can still lose their loan because of your association's financials. The building gets underwritten now, not just the borrower, which brings us straight to the number everybody's been talking about. Here's the second one, the big one, but before we do that, I just want to make sure that you understand what we're talking about because it sets this whole thing up. We just said that under a full review, the lender looks at the health of the entire community, not just the buyer's credit and their ability to pay. Fannie Mae and Freddie Mac are now underwriting your association's finances. Okay, this is the piece of those finances they care about the most. For years, the benchmark was that your association's budget needed to put at least 10% of its assessment income into reserves. Starting with loan applications dated on January 4th of 2027, that number now becomes 15%. So what used to be 10% is now 15%. Let's make this real with an example. Say your association collects $500,000 a year in regular assessments. That's your dues. Under the old rule, your budget needed to send at least $50,000 of that into reserves. Under the new rule, it's now $75,000. Same community, same dues. The bar just moved to $25,000 more than it was before. And I want to be clear about what happens if you miss it because it's not what you'd expect. This isn't a fine. Again, it's not a law, so you're not going to get in trouble for this or penalized for it. Nobody sends your board a letter. What happens is really less in your face, and honestly, I think it's worse. Let's just say that a buyer goes under contract on a unit in your building. Their lender pulls your budget during full review. They see the reserve fund is below the bar with no acceptable workaround, and that loan dies. Not because of the buyer, but because of your budget. The association, the condo association, is not warrantable. One underfunded line in your budget, and now every single unit in your building just got harder to sell. Let me say that again because I really need this to land. The moment your building falls out of warrantability, the number of people who can actually buy a home in it drops off a cliff. You're no longer selling to the whole market. You're down to really two kinds of buyers. First kind is just cash buyers, people who are going to negotiate you hard because they know you're stuck. And two, you've got buyers who can cobble together some kind of financing from a lender that isn't backed by Fannie Mae or Freddie Mac, which is a riskier loan. And a riskier loan almost always means a higher interest rate and a much more expensive mortgage. Fewer buyers, worse terms, that is a direct hit to what every unit in the building is worth. Now, let me get ahead of some of the confusion because there's a lot of misinformation floating around the internet on this. A lot of the coverage on these rules is coming out of Florida because Florida has been through the Surfside tragedy and has its own really strict laws, condo laws specifically. And if all you've seen is Florida coverage, you might walk away thinking that this is just a Florida problem, or maybe even just a really strict state problem, that somehow your state or your building is fine and this doesn't apply to you. This is not a Florida problem. This is not a state-specific problem. This is national, and here's why it's important to understand. Right now, across the entire country, only 13 states actually require a condo association to conduct a reserve study by law. 13. States like Florida, California, Nevada, Oregon, and a handful of others have real reserve study statutes on the books. That means in the other 37 states, there are no laws requiring your association to have a reserve study at all. But here's the trap. Board members in those 37 states hear reserve study rules and assume it doesn't apply to them because their state never required one. But remember where this rule actually comes from. It is not a state law. It's a mortgage requirement. And from two of the largest companies that buy most of the loans in all 50 states. Your state legislature has nothing to do with it. So follow this through. Say that you're in a state with no reserve study law in the books. Do you think that that just somehow gets you off the hook? Of course not. That's what we just talked about. It's the exact opposite. If you want units in your building to qualify for conventional financing, your board is very likely going to need to go out and get a reserve study conducted anyway. Not because your state required it, but because the mortgage market demands it. Your state never made you do it. The people buying the loans did. And to be clear, one more time, this does not mean that your board gets fined for not having one. There's no penalty, no citation. It just means that without meeting the standard, units in your building can't be sold to anyone who needs a conventional mortgage. And in most buildings or most communities, that's almost everyone. By the way, that is the warrantable idea from earlier, and now you're seeing it in action. A building that meets the reserve bar stays warrantable and loans flow to it. A building that doesn't goes unwarrantable or non-warrantable, and really the sales are going to dry up. There are real consequences to this. But here's the part that I really want board members to sit with. It's easy to hear all of this and think, all right, so some future seller might have a headache, whatever, we'll deal with it then. That framing is really kind of small because you're not just a board member, you're actually an owner in the building. Your unit sits under the same roof, the same budget, and the same warrantability status of every other unit. Your unit could be pristine with all the upgrades, but if the association isn't meeting the requirements, your condo just got grouped together with everyone else. You're in the same boat. When a building becomes non-warrantable, conventional financing dries up for everyone. We just walked through what's left, right? You're left with cash buyers who lowball you or expensive, riskier financing. Fewer buyers and lower offers on the unit next door becomes the comps for your unit. That's how this quietly reaches into your own pocket, right? You're grouped together with everybody. Everybody is in the same ship. So an underfunded reserve line isn't some abstract governance detail. It's a discount stamped on your largest investment. When your board funds reserves properly, you're not just protecting the association, you're protecting your own equity. It's the entire community, like I said. And this problem is everywhere. A 2025 survey by the Community Association Institute found that 42% of board members and managers weren't even sure whether their community was eligible for Fannie Mae and Freddie Mac financing. And of the communities that were found ineligible, 64% said it hurt home sales and property values. Nearly half of boards don't even know their own status, and you don't want to find out your status from a buyer's lender at the closing table. So what do you do if your budget just can't hit 15% by January? Maybe your dues are already stretched thin, or maybe getting there in one budget cycle means dues increasing and your owners are going to revolt and fight you on it, right? There is a second path, and this is the part of the rule most coverage gets flat out wrong or skips it entirely. So let's talk about it. An association that doesn't budget the full 15% can still qualify if it has a current professional reserve study and its budget funds reserves at the highest level that study recommends. Let me break that down carefully because it's, both halves matter. Think of it as two sides to the same coin. First, it has to be current. A study from, say, 2019 gathering dust in someone's archived emails doesn't count. It needs to be recent, generally within the last 3 years. And second, the highest recommended level, right? You need to understand that most reserve studies give you more than one funding option. There's usually a bare minimum plan, often called baseline funding, that basically just keeps your reserve balance from hitting zero or going into the negative. That minimum plan is now explicitly off the table for this. If you're using the reserve study path, the lender has to verify that you're funding at the strongest plan the study recommends, not the cheapest one, the strongest plan. Think of it sort of as a doctor handing you two different plans. One is the bare minimum just to keep you alive. The other is the full plan to actually get you back to healthy, back to baseline. Fannie and Freddie just said that the bare minimum doesn't cut it anymore. You have to go with the second option. So really every condo board has two doors into compliance. Door number one, budget 15% of your assessment income into the reserves. Door number two, keep a current reserve study and fund it at its highest recommended level. What you cannot do anymore is what a lot of buildings have unknowingly done for years, which is keep an old study in a drawer, fund whatever feels comfortable that year, and hope that nobody takes a closer look. Now, notice what both doors now have in common. You have to actually know your numbers, what your study recommends, what your current funding, and exactly what the gap is in between them, which raises the real question: how is a volunteer board supposed to stay on top of all of this? That is precisely what we built Solume for. Our software and our systems make this much easier than you might think that it is. I'll come back to that in a second. All right, here's your checklist. Step one, find out where you stand today. Pull your current budget, take your total annual assessment income and multiply it by 0.15. 0.15, that's 15%. Is your reserve contribution at or above that number? That one piece of math tells you whether you're already through the door number one or not. Step two, check your reserve study. When was it last done? If it's more than 3 years old or you don't have one at all, that is your top priority, because if you're not hitting 15%, that study is your only other door and it has to be current. Step three, compare what you're actually funding to the highest recommended level, not baseline, highest. If there's a gap, your board needs to close it in the next budget cycle or somehow get to 15%. One or the other before loan applications start hitting the new standard in January. Step four, get your documents lender ready. Remember, every loan now goes through a full review. Your budget, your reserve study, insurance, delinquencies, any litigation, your meeting minutes. When a buyer's lender comes asking, slow and scattered information stalls the closing. Clean, organized answers keep everything moving forward, and that helps keep sales moving forward. None of this is complicated, but all of it depends on your board actually being able to see its own numbers clearly, and that's where most volunteer boards get stuck. The reserve study is a PDF in someone's email, or the budget is a spreadsheet. The bank balance is some portal that you have to log into. Nobody's ever looking at all three side by side. Now, you might be thinking, that's what we pay our management company for, right? But I'd respectfully disagree with you on that and kind of push back on that. Hoping your management company has this handled is not a plan anymore, because they simply don't do it. Most property managers don't do it. Reserve study management is one of the things that management companies are notoriously bad at. They respond to the crisis of today, so it's not usually their focus. It sits in a drawer between budget season, and when a manager is juggling a dozen different properties at once, your long-term reserve plan is not what's keeping them up at night. So when a buyer's loan falls through in January, Saying that we assumed that the management company was on it is not going to be much comfort to the owner who thought that they could sell the property but can't. The board is the one on the hook, which means the board needs to be able to see all of this information for themselves. It's the exact gap we built Solume to close. Reserve study management isn't a bolt-on feature for us. It's a core feature of the software. Your study, your reserve balance, your contributions, and everything coming down the road all live in one place right next to your dues and your budget. So when the question is, are we funding at the recommended level? You're not digging through emails and you're trying to sift through some dated PDF hoping to find the answer. You open the platform and it's right there. All right, let's take an example within Solume's platform. We're going to click over here into the reserve study. So this particular community has a $57,000, $57,279 starting balance in reserves, and they add $10,000 a year as part of their reserve fund contribution. That might look pretty good if you're only looking at that number, but let's scroll down for a little bit and look at next year. So they can come down to 2027 and they can start to see some numbers here, right? There's that $10,000 that they were supposedly contributing. We'll come back to this budget line item in a second. And they have $28,000 in expenses, and there's 6 expenses that they need to look at. Now I want you to look at all of this information up here, all of these numbers you need to look at. So this is the 2027 reserve year for a 2023 reserve study. So the study, technically speaking, is within the 3-year period of this being conducted by. So let's look at all these numbers right here. There are 2 worlds on this screen: fully funded, which is what they should have, and projected, which is what they actually have. Watch this gap between them. So this is what their fully funded balance at the start of the year should be, and here's what their fully funded projected balance, meaning this is under ideal situations, this is how much money they should have by the end of the year. Now we can come down to here and say, this is what they're projected to have at the start of the year and projected to have at the end of the year. So you can already see that they're $49,000 in the hole of what they should have. Their fully funded balance at the start of the year should be over $179,000. This is what a healthy reserve would hold on January 1st of 2027. That's the target. That's what on track looks like for a community this age with all of these assets. So the fully funded balance at the year end, that's the target, and it should be hit. They're supposed to try to hit this number by the end of December. It goes up over the year because a healthy community keeps saving towards everything that's coming up. They're not just covering the needs of this particular year. So obviously the change in the fully funded balance, again, that's the target, is $23,000. They should accumulate $23,000 more in reserve funds in terms of contributions. Now let's look at the actuals, right? The actually have world, or the projected actually have. So the projected reserve fund balance at the start of the year, they're already in the hole by $31,000. And by the end of the year, they're going to be in the hole by $49,000, which means they are losing $18,000 more than what they need to spend on this particular year's budget. So this is what they're starting the year with. It's a negative, meaning they already owe more to their reserve than they have set aside. They're beginning 2027 by about $31,000 underwater. So this is where reality lands by year end. Those holes get deeper, not shallower. They finished nearly $50,000 underwater. So they are $18,700 less than what they should be in their contributions for that particular year. They're going backwards while the target keeps moving ahead. Percent funded is the single most important reserve health number. What you have versus what you should have as a percentage. Healthy is 70% or above. Under 30% is a red flag. Negative means that they have blown past underfunded. They're in a hole. They are in crisis mode. And if nothing changes by the end of this fiscal year, the end of 2027, they are going to be 24.5% underfunded. The trend line is pointed in the wrong direction and it's accelerating quickly. So what's driving all of these costs is this component instant count, right? They have 6 items that they are supposed to address this 2027 year, totaling over $28,000 in expenses. So you can see all of these costs here. These are the 6 items that are supposed to be replaced this year, and there's an annual inflation rate of 3% and each instance cost of how much these items are going to be. And if you add all those up, those 6 projects will cost about $28,700 this particular year. Money that, based on the negative projected balance above, it simply isn't there. So look at this. This $23,600 is what they should be adding toward their reserve, but they're actually end up losing $18,000 negative of what they're going to be doing. So there's a huge gap that's growing in this particular, all well over $28,000 in expenses are coming up in this year. So Freddie Mae and Fannie Mac are going to be looking at these numbers right here, the percent funded at year start and year end, based on when the actual loan application is completed. So if your community's funding balance at the start or at the time of the loan application, if it's less than 15%, you are in a world of hurt because you're not going to be able to sell homes in your community. So how would you solve this problem? We're not going to look at all this stuff. We'll come back to that in another demo. This would take way too long if we did that, but we're going to come over to here. And you can see here what this looks like. Again, I'm not going to go into great detail, but if we come down to 2027, you can see here that they are supposed to have $179,000 in reserves, accumulated reserves at that point. And here, they're actually going to be $31,000 in the hole if nothing changes between now and that point. And this graph here is just kind of truncated in size just for the demo purposes. But if we come up over here, we can open a scenario explorer. And by the way, I'll draw your attention to this, that it's telling you that based on all available data, that you're going to result in a $29,000 shortfall in 2025. So it knew 2 years ago, year and a half ago, because this is a 2023 reserve study, that this community was heading for a financial disaster and they were going to be $29,000 in the shortfall in that year. So all you would have to do is come over here to the scenario explorer and you can start to add increases. Now I'm not going to go into all this detail because that would make this video even longer than it already is. But if you want to see a live demo of this, please reach out to us to book a demo. I'd be happy to show you one. Somebody from my team or myself will even do it. I'll leave a link in the description. So having all this information at your fingertips to be able to log in and just produce a report based on this is the difference between hoping you're compliant and knowing that you are. So let me leave you with a few honest questions. Does your board know right now, without looking anything up or flipping through a PDF, whether your building would even pass a full review this January? And if a buyer's lender pulled your budget next month, would your reserves open one of those 2 doors, or would you find out that there's a problem when a sale in your building falls apart? If you don't love your answer to either of those questions, here's my offer. Give us 15 minutes. We won't even get into a demo. I don't want to waste your time if it's not a fit. Shoot, I don't even want to waste my own time if it's not a fit. So you tell us about your community and we'll give you an honest take on whether we feel like Solume can actually help you and whether it can't. And if we feel like it can and you feel like it can, then we can schedule a demo for you to be able to actually see this and even see it with your data that's in there. I'll leave a link in the description. Because come January, every condo building in America is going to be one of 2 kinds. The one where loans close or the one where they don't. And what your board does in the next few months is what decides which one you are. If this was helpful, please like and subscribe it so we can get it in front of more boards. Send it to somebody if you feel like they need this information. Thanks for watching. I'll see you in the next video.